3 weeks ago, President Trump called the Iran war very complete. Markets believed him, and oil dropped $13 in a single session. Since then, Brent crude has surged 50%, marking the steepest monthly gain since Iraq invaded Kuwait in 1990. The contradiction isn't just rhetorical. It reveals something structural. Markets have stopped pricing Trump's statements and started pricing the Strait of Hormuz. Vessel traffic through that choke point fell from over 100 ships per day before the war to fewer than 5. That single bottleneck is holding 20% of the world's oil and LNG hostage. The IEA released 400 million barrels from strategic reserves, and prices kept climbing anyway. Brent touched 119 last week. On Monday, it settled near 113. The national average gas price in the U.S. hit $3.99, up from $2.98 in February, a $35 monthly hit to the average driver's disposable income. What makes this shock different from prior ones is the compounding. Houthi forces entered the war over the weekend, opening a second maritime front at the Bab el-Mandeb Strait. Societe Generale is now forecasting a base case of 125 Brent for April, with credible spikes toward 150 if that second strait closes. The Brookings Institution's Energy Security Director put it plainly, markets are underestimating this war. They still expect a quick resolution. The evidence doesn't support that. That oil shock has put the Federal Reserve in an impossible position, and Jerome Powell said so out loud on Monday. Speaking at Harvard, Powell acknowledged that oil is now pushing headline inflation higher, but that the Fed's tools have no meaningful effect on supply shocks. He can't drill more oil. He can't reopen the strait. Rate hikes would arrive in the economy just as the shock resolves, potentially making a slowdown worse. So he held his ground. Rates remain at 3.50 to 3.75%, which Powell called a good place. That single phrase triggered a significant reversal in bond markets. Traders who had been pricing out any 2026 cuts and even betting on a hike in late 2027 reversed course. Fed funds futures now show rate cuts returning to the back half of 2027 as the base case, with near zero probability of a near-term hike. The bond rally gave equities a partial lift. Alcoa surged 11% after Iran struck aluminum plants, a reminder that this conflict is repricing industrial metals, not just energy. But the relief may be temporary. Core PCE sits near 3%, and tariffs are already adding 0.5 to 1% to that figure. Powell is watching inflation from two directions at once, supply-side oil and demand-side tariffs, with instruments designed for neither. Kevin Warsh, Trump's Fed chair nominee awaiting Senate confirmation, is expected to lean toward cuts. If he takes the seat in May, the policy stance could shift, but by then, the oil shock will have already done its work.
While the oil war dominated headlines, a different kind of energy was building in the IPO market. SpaceX is expected to file its prospectus with the SEC this week or next, targeting a June listing and seeking to raise more than $75 billion, more than double Saudi Aramco's record 2019 offering, and more than the total proceeds of all U.S. IPOs last year. The company, which now includes Musk's AI following a February merger, is being marketed at a valuation above $1.75 trillion. The filing would be the first time SpaceX publishes public financials. Morningstar estimates 2025 revenue near $16 billion, driven almost entirely by Starlink subscriber growth. Space-adjacent stocks have already started to move. EchoStar jumped 8% in a single session. It holds a deal to receive up to $11 billion in SpaceX stock in exchange for wireless spectrum. Rocket Lab gained 3.6%, building on record 2025 revenue of $602 million and a $1.85 billion backlog. The structural tension is this. Up to 20% of the IPO is reportedly reserved for retail investors, double the typical allocation. That is a deliberate move to broaden the shareholder base, and it creates a rotation risk for Tesla. If retail investors redeploy capital from Tesla into SpaceX, the stock that has already fallen 20% year-to-date faces an additional headwind. The weight of evidence here points toward the SpaceX narrative sustaining the space sector through listing day, but only if the IPO pricing holds and the war premium doesn't pull capital back into pure energy plays. If Brent spikes toward $150, the appetite for a $75 billion growth bet in a war economy becomes the variable to watch. The verification benchmark, SpaceX's SEC filing date, and the EchoStar Spectrum deal close timeline in late 2027. If the filing is delayed past April, the momentum in space stocks will fade quickly. And that would tell you something about whether even the biggest IPO in history can hold investor attention when oil is the only story.